Stockholders' equity. Common stock represents the contributions made by the owners or shareholders of a company in exchange for ownership rights. It is recorded in the equity section of the balance sheet because it reflects the residual interest of the owners after all liabilities have been paid. This account is fundamental for businesses because it provides the initial financial resources needed to start operations and expand. The amount of common stock issued depends on the company's charter and is usually divided into shares with a specific par value. Investors who purchase these shares become partial owners of the company and have voting rights in major decisions. The business entity principle states that the company's equity is separate from the personal finances of its owners, so these contributions belong to the company and are not mixed with personal assets. Additionally, the historical cost principle requires that these contributions be recorded at the value agreed upon at the time of issuance, not at market value. From a management perspective, issuing more stock can raise additional capital without creating debt, but it also dilutes ownership among existing shareholders. Therefore, companies must carefully consider the balance between equity financing and debt financing. For investors, the common stock account reflects the level of confidence owners have in the business, as well as its capacity to attract external financing. A strong equity position is often seen as a sign of financial stability. Example, if the owners of a company contribute $100,000 in cash to start the business, this amount is recorded as common stock under equity. Retained earnings represent the cumulative amount of net income that a company has kept rather than distributed to shareholders as dividends. This account grows when the company is profitable and decreases when it incurs losses or pays dividends. The importance of retained earnings lies in their role as an internal source of financing. Instead of borrowing or issuing new shares, companies can reinvest their profits to expand operations, acquire assets, or develop new products. This strengthens financial stability and reduces dependence on external financing. The matching principle applies because earnings retained in the company must match the periods in which profits were generated. The going concern principle also plays a role, as businesses are expected to use these retained profits to continue operating and growing. A strong retained earnings balance indicates that the company has a history of profitability and financial discipline. However, if retained earnings are too high and the company does not reinvest or pay dividends, shareholders may question management strategy. On the other hand, negative retained earnings accumulated deficit may signal financial trouble. From a decision-making standpoint, management must decide whether to reinvest profits, pay dividends, or a combination of both. These decisions impact growth, shareholder satisfaction, and stock price performance. Example, if a company earns $50,000 in net income and decides to pay $10,000 in dividends, the remaining $40,000 is added to retained earnings. Additional paid-in capital refers to the amount investors pay for shares above their nominal or par value. It appears in the equity section of the balance sheet next to common stock and represents extra contributions from shareholders beyond the stated value of the shares. This account is important because it shows that investors are willing to pay more than the nominal price, which reflects confidence in the company's future performance. The extra funds strengthen the company's financial position and provide resources for growth without increasing debt. According to the historical cost principle, contributions are recorded at the amount actually received, not at market fluctuations. The full disclosure principle also applies, as companies must report the total additional paid-in capital to shareholders and potential investors. From a strategic perspective, issuing shares at a premium can improve a company's capital structure and reduce financial leverage. However, it also comes with dilution risk if too many shares are issued. Example, if a company issues shares with a par value of $1 for $5 each, the $4 difference per share is recorded as additional paid-in capital. Treasury stock refers to shares that were previously issued to investors but later repurchased by the company. These shares are held by the company and are not considered outstanding, meaning they do not pay dividends or have voting rights while in treasury. Companies buy back their own shares for several reasons: to reduce the number of shares in the market, increase earnings per share EPS, support the stock price, or prepare for future reissuance as part of employee compensation plans. The cost principle applies here because treasury stock is recorded at the price paid for the repurchase, not at its current market value. This account reduces total equity because it represents resources spent to buy back shares rather than being used for other investments. From a strategic perspective, share repurchases can signal management's confidence in the company's value. However, excessive buybacks may limit funds available for operations or growth. Additionally, companies must comply with legal restrictions and shareholder approvals for buyback programs. Investors view treasury stock activity as an indicator of company strategy. A moderate buyback program may boost investor confidence, but aggressive buybacks could suggest a lack of profitable investment opportunities. Example: if a company buys back 1,000 shares at $20 each, it records $20,000 as treasury stock, reducing total equity. Dividends are the distributions of a company's profits to its shareholders, usually in the form of cash or additional shares. They are not considered an operating expense. Instead, they represent a reduction of equity, specifically retained earnings, when declared. Once dividends are officially declared by the board of directors, the company incurs a legal obligation to pay them, which is then recorded in the financial statements. Dividends are important because they signal financial strength and stability. When a company declares dividends, it shows confidence in its ability to generate future earnings, shareholder expectations, and growth opportunities. There are different types of dividends. The most common are cash dividends, which reduce both equity and cash when paid. Stock dividends issue additional shares to shareholders instead of cash, transferring an amount from retained earnings to common stock and additional paid-in capital. Less common are property dividends, which distribute non-cash assets. These actions do not affect net income since dividends are not an expense, but they do influence key metrics like earnings per share, especially when stock dividends increase the number of shares outstanding. Example: if the board declares $10,000 in cash dividends, the entry at declaration is debit retained earnings, $10,000. Credit dividends payable $10,000 when paid. Debit dividends payable $10,000. Credit cash $10,000. This reduces equity and cash but does not affect net income.